This is Chapter 4, Going into Debt, discussion number 3, Credit Bureaus. So when you apply for credit, when you go to a bank and they say, well, are you going to pay back your money? And of course you're going to say, yes, I'm going to pay back your money. Can the bank really trust you? Do they know anything about you? Well, if you do business with them, in some ways they know something about your financial situation. But they don't know everything about your financial situation. They don't know if you've got loans to other banks or if you owe money to a whole bunch of other people. And so what banks do is that they utilize what's referred to as a credit bureau. Now, the credit bureau is a private business where organizations such as a bank can go to and say, you keep track of this person or essentially everyone's uh, amount of loans that they have out, the amount of credit cards they have out. It's kind of a cooperative effort so that these banks don't get surprised by some new development that they didn't know about when they decide to loan you the money for your house or your car. Now, there are three primary credit bureaus that most people refer to when they're checking your credit history. They are known as Experian. There's also another one called Equifax and another one called TransUnion. So anyway, banks will generally pick at least one of these, sometimes two. And if you're going for a mortgage, sometimes they'll go to all three and they'll say, okay, please give us this person's credit history. And they have a record of all the loans that you have ever have gotten, and then whether you paid them on time, if there's been any complaints against you for paying late or not paying at all those ideas are included in that credit rating. And then what these credit rating companies will do then is probably assign you a number, your credit number. And you've probably seen commercials about that too. And essentially that is a number that it's an easy way for banks to say good rate, good risk, bad number, bad risk. Higher the number, the better you are as a risk for the bank, the more likely that you're going to be paying things back. Now, credit rating can also be dependent on how much income you have. If you've declared bankruptcy at all, because bankruptcy means that you don't have to pay back the people that have loaned you money. How often you've left bills unpaid, and whether you have collateral. Collateral is that stuff that you have, whether it be a property or a vehicle, that could be taken instead of money so that the bank could sell it and then get its money back. Now, if you have a promise of collateral, for example, if you buy a car, then generally the car can be the collateral. And banks are hoping that they'll get their money back. Or you could say, okay, I want to buy a car, but if I don't pay for the car, you can take um, part of the house, or you can take, they're not going to saw off the house, but they could take some equity out of that. Now, if it's an unsecured loan, that means that the bank does not have collateral, and it's simply hoping and trusting that you will pay the money back. Of course, they can threaten you with ruining your credit rating. They could threaten you with They could try to threaten you for different things, but that's the important difference between a secured loan and an unsecured loan. So let's say you want to be a smart aleck and not pay your loan back. Well, that obviously is going to ruin your credit rating. As banks see that you don't pay back the loans, they're going to be less likely to loan it to you. Or they're going to say that you're a much bigger risk for us to loan money to. And because it's a risk, we're going to charge you more to borrow money from our bank. So that's happens a lot of time. If you don't pay back your loans, that means your interest rates are going to go up. And that means borrowing money becomes more expensive and it may become cost prohibitive, where you're saying, I can't afford that kind of payment. Also, you get visited by collection agencies, and they will come bother you and pester you, and they will do everything they can in order to get the money from you. Sometimes that they can call some of your money from your paycheck in order to pay the debts. Either way, it's going to make your life miserable by not paying back loans. And so that's one thing you really want to aim for, is to pay your loans back on time so that your credit rating stays up, so that when you want to borrow money, it's going to be less expensive. Credit card companies will trust you and give you a higher credit limit, again, assuming that you're going to keep on paying off those credit cards. and that the banks are going to say, hey, yeah, we'll loan you money. We'll be glad to loan you money, because remember, banks make money off of the loans, but they lose it if you don't pay it back. So if you prove yourself or show yourself to be a trustworthy loan applicant, and they see that you pay things back, yeah, they'll loan you money. They'll be glad to. This concludes discussion number 3, the credit bureaus, on Chapter 4, Going into Debt.